Vanguard says that owning foreign stocks may actually reduce your volatility of your portfolio and increase returns. We're going to talk about that. It's a good article, a PDF that Vanguard had put out, dateline February 2019, which I just came across, which is good stuff. I think one of my subscribers sent this to me, so I can't remember. I think so. So thank you, sir. All right, or ma'am. So let's dive into this. Vanguard, the Vanguard research team is fantastic. It's one of the premier out there. I love them, what they do for sure. I don't know any of these guys, Kimberly Stockton, Scott Donaldson, or Brian Scott. But let's read the synopsis here, shall we? Regardless of where they live, investors have significant opportunity to diversify their equity portfolios by investing outside their home market. Despite this opportunity, investors on average have maintained allocations to their home country that have been significantly larger than the country's market capitalization. We're going to talk about that. And each market we examined, our analysis indicated that volatility was reduced, most with an allocation to international equities of between 40 and 50%. While this observation may help investors determine the appropriate mix of domestic versus international equities, volatility reduction is not the only factor to consider. The paper concludes that although no one answer fits all, investors, I want one answer fits all. Global market capitalization weight serves as a helpful starting point in determining the appropriate allocation between domestic and international equities. In practice, many investors will consider an allocation to international equities well below global market capitalization based on their sensitivity to a number of considerations, basically home field bias. But we'll talk about that. First of all, I want to show you something here I thought was pretty interesting. Can multinational corporations provide enough exposure? I hear this a lot, actually, that, hey, a lot of my companies I own are in the S&P 500, which sell 40% of their services overseas. Coca-Cola is selling to China, for instance. And Vanguard answers that. One common question about exposure to stocks outside one's home market is whether domestic multinational companies have enough coverage of foreign markets embedded in their prices. The thinking goes that because many large domestic firms generate a significant portion of their revenue from foreign operations, the diversification benefits of global investing are already reflected in their price. While this aspect of globalization cannot be ignored, we believe it still makes sense for investors to hold international equities for several reasons. First, simply focusing on domestic companies means an investor has no stake in leading global companies that are domiciled outside their home market. Second, many firms seek to hedge away currency fluctuations of their foreign operations. Although this can help smooth revenue streams, foreign exchange can be a diversifier for an investor's portfolio. Finally, a portfolio made up solely of domestic firms is less likely to have a less diversified sector exposure than the global equity market portfolio. That's not as convincing as I'd like, but let's keep going down here. So first thing I want to show you, this is the chart. Historical mix of the global equity market capitalization. And so here's the U.S. market in 1970. It's about 65% of the total U.S. Total stock market, the world's stock market. The U.S. was about 2/3. The foreign's about 1/3. Go down here to 88. The U.S. is about 30% or so, and the rest of the world was 77. Go up here to 2018. The U.S. is about 55%, and the rest of the world is 45%. From a pure market cap weighted theory here, we'd say then your stock portfolio should represent 55% U.S. and 45% international. That might be a little bit bridge too far, but that gives you a synopsis here. They're saying, look, at the end of the day, the U.S. represents 55% of the entirety of the world stock market. Foreigners represent 45%. So you should have 55 exposure and 45 foreign. The problem with that, of course, if you would have done 1987 and only had 23, I guess that's 20, let's say 30% U.S. and 70% foreign, you would have underperformed. I think. I don't know, actually. I don't know. I didn't run the numbers. So we'll see here. All right. The case for investing, let's see. We already talked a little bit about that. The rationale for diversification is clear. Domestic equities tend to be more exposed to the narrower economic and market forces of their home market, while stocks outside an investor's home market tend to offer exposure to a wider array of economic and market forces. These differing economies and markets can produce returns that can vary from those of an investor's home market. I want to show you these charts here, and they're basically volatility of returns for country in the global market. So here's a U.S. Australia is much more volatile. So the longer this graph is further on the right, the more volatility it is. So here's the U.S. If we scroll down here, here's the developed market without the U.S. Here's emerging markets, very volatile, and here's a global market on a whole. So the developed markets without the U.S., all right, so that'd be, well, Europe, Japan, let's see, we go up, are more volatile than the United States. So the United States, by far and away, is the least volatile market out there in terms of all the developed countries, for sure. Then here's emerging markets, pretty volatile. The global market as a whole, the annualized volatility is right about 14%, and the U.S. is right about, it's probably 15%. That's dated January 1970 to September 30th, 2018. So it's almost a 50-year track record. So it's pretty interesting. It's interesting how the global market is actually less volatile than any of its pieces combined. Isn't that interesting? So it just shows you, that Italy is very volatile, right? I mean, here's Italy. Here's Hong Kong, incredibly volatile. That's twice as volatile as anything else, it looks like, in terms of, they look at, well, not twice, well, pretty significantly more volatile than anything else that's out there. China isn't in here. Brazil is not in there, so mostly European, Japan, that's pretty much it looks like. Yeah, European, Japan, but China's not in there. Anyway, the whole point about this is the volatility of the global world is less than any of its parts, which is interesting, which just shows you sometimes the U.S. is crazy volatile, sometimes Switzerland is not. Combined, they're less volatile, though, than anything else that's out there. Interesting. And that would be one of the reasons to have international stocks, because it's more, or it should say significantly more volatile. Significantly less volatile than having any of those countries in particular. Does that make sense? Global exposure, how much should you expose yourself to global stocks? We just kind of talked about that. U.S. investors who follow a market cap weighted approach would invest 55% of their equity portfolio to U.S. and the rest would be international. That's too high for me. But here, I want to show you these charts right here. Adding international equity is expected to reduce the total volatility of a portfolio across markets. So here's the U.S. adding a, 50% or 40% portfolio to international will reduce your volatility by about 5%. It looks like 3 to 5% on an annual basis. That's pretty good. All right, so 10-year expected volatility and reduction, 10-year expected reduction of volatility over 10 years, it'd be about, roughly 5%. So if you're in the U.S. and you add international equity and you did say 40% of international equity, you'd reduce your portfolio by about 5%. The volatility is just a change in price. So from $100 to 110, it would now go from $100 to 105, if that makes sense. 10-year expected reduction in volatility for Canada. If you were to do the same thing, 40% in Canada, you'd reduce your portfolio volatility by 10%. Let's see, non-Australian, this is Australia, if you say by 15%, if you were to invest about 40 to 50% in non-Australian stocks, you'd reduce your volatility by 15%. And here's the UK, about 10% or so. So if you have a 45 to 50% exposure to international stocks, you'd be expected to reduce your portfolio pretty significantly over the next 10 years. Is that worth it? Well, we're going to show you why it might well be. Let's see, changing diversification benefit. A primary change in the global equity market that has influenced global diversification is the increase in average return correlations. Correlations between returns of stocks in the U.S. and those outside the U.S. have increased significantly from approximately 0.35 to 0.8 over the last 30 years or so. Although their longer-term correlations were stable through the 1980s and early 90s, they increased fairly dramatically between 1994 and 2010. Since then, the trend in long-term correlations across equity markets began to flatten, perhaps implying a ceiling to the correlation. So here we go. This is the blue is the correlation for 10-year rolling terms. So basically we have about a 0.5% correlation. So one correlation means when I go up 100, you go up 100. A 5 correlation means when I go up 100, you go up 50. Or if I go down 100, you go down 50 or something like that. Does that make sense? So as you can see, we started at 0.5 in 1979 on rolling 10 years. Now we go to 2018, it's up to about 0.8. So there's an 80% correlation now, but still that leaves 20% of the market non-correlated. But on any given year, I mean, look at this. This is 2017, negative correlation. One went up, you went down. That's negative correlation. Here's 1993, I guess. Yeah, probably 1993. Same thing, negative correlation. So even though it's flat over 10 years, relatively speaking, we're at 60 to 80, zero point 0.6 to zero point 0.8 on any given year, the correlations are not flat. Does that make sense? So that's, the only thing that really matters is on a year-to-year basis. That's what you're dealing with. All right, let's keep going. Diversification of return opportunities. Another benefit of global diversification is the opportunity to participate in whichever regional market is outperforming. This is a critical component of diversification that correlation does not effectively capture. For example, while the U.S. may lead over some periods, another country or region will invariably lead over other points. Figure 6 demonstrates the near-term benefits of global diversification. Let's take a look. There's figure 5. So real quick. So domestic equity and unhedged internationally equity 50-year median correlations. Here's a U.S. So over 30 years, we have basically 3/4 of full correlated. So I go up 100, you go up 75. And Canada is only 0.57, and Australia is 0.58, and then UK is 0.66. So in Canada, I go up 100, you go up 57. Australia, I go down 100, you go down 58. Does that make sense? And that's the, even though U.S. is pretty highly correlated, it's still, a third of it. Basically 25, of it is not correlated at all, which is kind of interesting. And here's the returns. Trailing 12-month differential return U.S. and non-U.S. stocks. So, let's look at this. So in 2018, the U.S. stocks outperformed by significant 20%. Here's the difference in total return. 20%. In 2010, international outperformed by 20%. 2000 and 1995, U.S. way up 1994. So you can see, so while the correlation is flat, like if we just look at this chart right here on a rolling 10-year basis, on any given year, there's huge volatility in the correlation. Look at that. Up and down, up and down, up and down. So this is where they're both equal. The zeros when they're both equal. In 2018, the U.S. was way ahead. In 2017, the international is a little bit ahead. So the U.S. has been way ahead for quite some time. 2009, basically 2010 on, the U.S. has been ahead pretty significantly. So it'd be interesting to see how that shakes out. We expect return patterns between domestic and international equities will continue to differ regardless of where an investor lives, leading to a continued benefit from diversification. Let's see. Okay, so figure 7 illustrates the forecasted distribution of 10-year returns for domestic and global equities. So let's take a look here. So here's a 50%, so basically they think 50% chance this will happen. Canada equity will be 3.7. Unhedged equity, global equity would be 4.8 ex Canada. So they're saying, look, if you're in Canada, you're going to get, we project over the next 10 years, you'll get 3.7. But if you're not hedging, you'll get 4.8 if you take out the whole global market without Canada. And hedging just means you're hedging the foreign currency exchange risk, if that makes sense. U.S. equities, they have a 50% chance, so they think 50% likelihood, so half will happen, half it won't. 3.8% for U.S. and then unhedged global equity 7.1. So again, they're thinking significant global equity outperformance of the U.S. over the next 10 years. And then if they look at all these different ones, there's a 5 to 10% chance the U.S. will be negative, and there's a 25 chance it'll only be 1.3. A 90% chance will be 8.8. So I like looking at essentially the median, 50% above, 50% below. So they think 3.8 is the median, if that makes sense. Then we go to Australian equities. They think Australian equities will actually outperform global ones right here. So they think Australia get 5.5 and global only get 4.9. So that might mean you want to load up on Australian stocks. I don't know. UK is the same thing. So it's pretty interesting. 10-year expected returns are based on the median of 10,000 different simulations from the Vanguard Capital Markets Group in local currency. And again, unhedged means they're not hedging against the currency fluctuations. Let's see here. So they talk about hedging versus unhedging, and they say, look, if you're unhedged, there's a currency contribution to volatility. So unhedging is much more volatile than hedge. So here's a hedge, and here's the unhedged. Hedge just means they're buying options to try to minimize the currency volatility of exchange rate risk and whatnot. So when you're not hedging, you get significant more currency risk than you do if you are hedging, if that makes sense. In fact, here we got hedge in Australia. So hedging is not always a winner, because here they got Australia. When they don't hedge, they get less volatility than when they do hedge, because they're losing money, because they think Australia will be outperforming the global market. So hedging against currency risk would actually be a net loss, essentially, if they're true that Australia outperforms, I guess. I didn't really dig that deep into it, but conclusion. In light of our quantitative analysis and qualitative considerations, we have demonstrated that domestic investors should consider allocating part of their portfolios to international equities. And determining how much to allocate between domestic and international equities, a helpful starting point would be for investors is global market capitalization weight. In practice, many investors will consider an allocation below this starting point based on their sensitivity to, again, this home market bias. So pretty good article. Again, Vanguard, I'm a big fan. I think you should definitely sign up for Vanguard Capital Markets Insights for sure. I think you'll get a lot out of that. But something to consider. Don't just think, hey, I got the S&P 500, so I've got my international exposure covered. I mean, I think there's a legit argument to say that. But, I mean, at the end of the day, you put 10% international, not going to kill you. It will make or break it, no. But, just having diversification with international stocks is probably not going to prove to be a bad thing. If anything, it might actually make you more money and reduce volatility. Yeah, we'll see, though. We just don't know. All right, thanks for watching.